Alright, and here we are. Welcome to Chapter 13. Now in Chapter 13 we're going to be sort of bringing it all together. We're going to be taking all those ratios that we talked about during the semester, and we're going to talk about those and see what they are and how we compute them, sort of give you another look at those, and then we're going to add a few more. And we're going to talk about financial analysis of a company, and we're going to see how it works looking at a couple of different types of analysis. And what we're going to be doing, we're going to be using horizontal analysis, vertical analysis, and ratio analysis. And we're going to define what those three things are and talk about the different ways we can compute them. Alright, horizontal analysis. It's also known as trend analysis. And what we do is we're going to look at financial statements one year to the next. We're going to look at it over a period of time, and we're going to see the increase or decrease that took place in different levels of the financial statements. And so we can look at those both at on the balance sheet and the income statement. We can see the changes that have been made. Let's take a look at an example real quick. Here we have a financial statement for the Chicago Cereal Company. And what we do in this type of analysis is we're looking at one year to the next. So we go from 2008 to 2009, and we see both what the amount of change was and the percentage change. This type of analysis, going sideways horizontally one year to the next, tells us that we changed by 290 or 11.9% in our current assets. So our total assets, we take a look, we went from 10,714, it's in thousands, so it'd be 10,714, to 11,397. That's a change of 683 or 6.4%. We can see what percentage we changed from one year to the next. And so we either went up, went down, however it went, the difference, the percentage change, and the amount of change one year to the next. And so the key to horizontal analysis, you're going one year to another. Alright, then we have vertical analysis. Vertical analysis is going to be up and down. Horizontal is sideways, vertical is up and down. And this is often called common size analysis. And what we're going to do is we're going to be able to look at our balance sheet and income statement, and we're going to be able to tell how they look, and we're going to be able to compare companies of different sizes as well. So what we do is we take a look, and here we go one year to the next just like we did before. So in looking at our Chicago Cereal Company, we had net sales in 2008 of 10,907, and what we do is we make that top number our 100% mark. What that means is we do our sales minus our cost of goods sold gives us gross profit, and then minus our selling and admin expenses gives us our operating income, and then we've got plus and minus the other gives us income before income taxes. Then we take off our taxes and we end up with net income. That's our multi-step income statement. What we're able to show here is if we have 100% being our net sales figure, that's 100%. If we look at net income, we had sales of 10,907,000. We had net income of 1,004,000. And so what that means is net income was 9.1% of sales. So we can take a look at the net income being a percentage of the sales. And we can look at one year and then look at another year. We can look at 2009 and we see our sales went up and our net income went up. But not just as a number, it also went up as a percentage. So in other words, we were able to keep as net income more than we did the previous year as a percentage. So net income in 2009 was 9.4% of net sales. And so it tells us what percentage that we have one year or another year. But you can also do this with companies of different sizes. If we take a look here, General Mills is huge. Chicago Cereal, not so big. But we can take a look at these two companies and we can see that General Mills, which is in the millions, so in other words this is 1.3 billion, and Chicago Cereal, which is in thousands, so that's 1.1 million, very, very different. General Mills is much larger. But we can see how two different size companies are doing compared to each other on a percentage basis. In other words, both of them use 100% as their net sales figure, and then we take a look. General Mills keeps 8.9% in that year of its revenue, of its sales, as net income. Chicago Cereal, on the other hand, keeps 9.4% of its net sales as net income. And so even though Chicago cereal is a lot smaller, in some ways it's doing better. It keeps more of what it actually makes. And so we can compare different types of companies, different size companies with each other using this type of vertical analysis, And now we have ratio analysis. Ratio analysis is what we've been doing all along, these ratios throughout the semester. And we can classify ratio calculations into three different kinds. We have liquidity, we have solvency, and we have profitability. Three different types of ratios: liquidity ratios, solvency ratios, and profitability ratios. Let's take a look at some liquidity ratios. Liquidity ratios include something called working capital. Working capital is just our current assets divided by our current liabilities. Current assets, those assets which are going to be used up or consumed or converted to cash within a year or the operating cycle, minus current liabilities, liabilities we have to pay within a year or the operating cycle. Then we have the current ratio. The current ratio is current assets divided by current liabilities. We talked about that one along the way. The next one is something called current cash debt coverage ratio. It's our cash flow provided by operations. So this gets a little bit more to the heart of it, divided by our average current liabilities. And we'll talk about what that does when we get to the description of it in just a minute. And then we have the inventory turnover ratio, which we talked about. How quickly do we turn over that inventory? Are the goods coming in and going out in a relatively quick manner? Then we have days in inventory. It tells us on average how many days our inventory stays on the shelf. We have our receivables turnover ratio, which is our net credit sales divided by our average net receivables. And so that tells us how often we collect our accounts receivable. And then we have our average collection period, how long on average it takes us to collect that accounts receivable. And this tells us how liquid we are. These ratios tell us how much we're able to, or how well we're able to pay our short-term debts. Are we liquid enough to pay the short-term debts? Do we have liquidity? Do we have access to cash to be able to pay that? Then we have solvency ratios. Solvency is for the long haul. A few different solvency ratios we have. The debt to total assets ratio. What are our total liabilities compared to our total assets? What do we owe compared to what we own? We have the cash debt coverage ratio. That's our cash flow from operations divided by our average total liabilities. What we get from operating divided by how much we owe to people. Then we have something new. It's called the times interest earned ratio. It's our net income plus our interest expense plus our taxes expense divided by our interest expense. And what that is, it's going to basically tell us how well we're able to cover that interest. So are we able to make our interest payments as they come due when we borrow money? And then we have something called free cash flow. Free cash flow is our cash provided by operating activities minus our capital expenditures minus our dividends. It tells us how much we have left over to mess with after we pay capital expenditures and dividends. And then we have some profitability ratios. Profitability means how well we're doing. Are we making money? And so some of those, we have something called earnings per share. Our net income minus preferred stock dividends, because we have to pay those preferred stock dividends. Our net income minus preferred stock dividends divided by the average number of shares we have outstanding. So for every share of stock, how much did we make in net income? Then we have something called the price to earnings ratio, and this has to do with what our stock is trading for on the open market. Our stock price per share divided by our earnings per share. We have the gross profit rate, which is our gross profit divided by net sales. Our profit margin ratio, which is our net income divided by net sales. Our return on assets, which is our net income divided by our average total assets, and then the asset turnover ratio, which goes along with it, which is our net sales divided by our average assets. Then we have the payout ratio. This is the dividend payout ratio. It's cash dividends that we declare on our common stock, not preferred, but common, divided by net income. So in other words, how do we do in paying out common stock dividends? So the dividend payout ratio. And finally, we have the return on common stockholders' equity ratio, which is our net income minus those preferred stock dividends divided by our average common stockholders' equity. So these are the different types of ratios we're going to talk about. We're going to go through them really quickly. All right, so liquidity ratios are going to include several ones. It's going to be the current ratio, current cash debt coverage ratio, receivables turnover, average collection period, inventory turnover, and days inventory. And then we're going to add one to this list that we'll talk about briefly. The first one, the most popular one, is the current ratio. The current ratio is our current assets divided by our current liabilities. We see that in 2008 they had a current ratio of 0.6, and in 2009 they're doing a little better, 0.67. But what does that mean? It means 0.67 says that for every dollar of current liabilities, we only have 67 cents of current assets. That means for every dollar we got to pay in the next year or so, we only have 67 cents in current assets. That's not a good thing. A current ratio less than 1 is not good. You see General Mills and the industry, they have a current ratio of 1.2. It means for every dollar that they owe in the next year or operating cycle, they have $1.20 to pay it with. So Chicago Cereal got to do a little bit of work there. All right, there's another ratio called the quick ratio. It gives us a little bit more of a faster, or a little bit more of a quick look at how well we're able to pay our bills. It doesn't take all of our current assets into account. It only takes 3 of them: cash, short-term investments, and accounts receivable. Other types of current assets are not listed. So other things, supplies, inventory, all those other types of things are not listed there. Only cash, short-term investments, and accounts receivable. So if you have a current ratio of 0.67, well, your quick ratio is going to be even smaller because you're using fewer assets. And so the quick ratio tells us, can we quickly, or do we have enough assets that are really easy to turn into cash? Do we have enough of that to pay our current liabilities? All right, another liquidity ratio is our cash debt coverage ratio. Our cash debt coverage ratio tells us basically if we have cash flow provided by operating activities, does it handle our current liabilities, the average current liabilities? And here we start to get into the weeds a little bit, in the sense that we're looking at where the rubber meets the road as far as what you're going to use to pay those bills. And so cash from operations, that's going to be used to pay those bills. And so when we take a look at this, we take our cash provided by operations divided by our average current liabilities, and we see that Chicago Cereal has about a 3.9, 3.7, about a 3.8 or so cash debt coverage ratio. Now we have our old friend, the receivables turnover ratio. We've talked about this along the way. This tells us roughly on average how many times a year we collect our outstanding accounts receivable. So how are we doing when it comes to collecting what's owed to us? And our ratio for that is the net credit sales divided by our average net receivables. And we see for Chicago Cereal, it's about the same 2008 to 2009. We collect our accounts receivable about 12 times a year, so 11.9 or 12 times a year. It's a little bit lower than the industry average of 14 times. And along with that, we have the average collection period. Now, we can't do the average collection period until we get the receivables turnover ratio first. And so we take 365 and divide it by the receivables turnover ratio. What does that mean? That means Chicago Cereal, on average, collects its accounts receivable about every 30.5 days. 30.4 in 08, 30.7 in 09. And so the collection period, the amount of time it takes for us to collect money from people, on average, about a month. But we see in the industry, generally speaking, they collect it a little bit quicker than we do, about 4 days quicker than we do. And so we're not doing that great a job in getting our collections in compared to the rest of the industry. All right, the next one is our inventory turnover ratio. The inventory turnover ratio tells us how many times we clear out our warehouses and we replace it with all new inventory. So how many times our inventory is cleared out and replaced with all new stuff on average every single year. And that's computed by taking our cost of goods sold and dividing it by our average inventory. So cost of goods sold divided by average inventory gives us that turnover ratio. And Chicago Cereal in 08 turned over its inventory 7.9 times, in 09 7.5 times. And so we're not doing as good as we were last year. It's taking us a little bit more time to turn over that inventory as opposed to last year. But They're way above the industry average and General Mills. General Mills is slower at turning over its inventory, and the industry is slower at on average, slower than at turning over its inventory than we are. So Chicago Cereal is doing good in moving that inventory, fresher stuff, moving it out pretty quickly. And then we have our days inventory. Our days inventory is basically 365 divided by the inventory turnover ratio, just like the receivables turnover that we talked about. And so this tells us, on average, how long the stuff stays on our shelves or stays in our warehouse. So on average, when we have inventory, in 08 it stayed there 46.2 days. In 09 it went up 48.7 days. It's still better than the industry average and General Mills. They, on average, keep their stuff in their warehouse about almost 60 days. So we're doing better. Our stuff is fresher, moving in and out much quicker. All right. Let's take a look at these things called solvency ratios. Solvency is for the long haul. Tells us what our ability is to survive over a longer period of time. Are we going to be around for a while? And we got several different ones that are several different ratios that are going to go ahead and tell us a little bit about our solvency. Can we stick around for the long haul? So we have debt to total assets ratio, times interest earned ratio, and the cash debt coverage ratio. And then we have something called free cash flow, but we'll talk about that in just a second. The first one is the debt to total assets ratio. That's going to be our total liabilities divided by our total assets. So everything we owe divided by everything we own. So if we take a look at Chicago Cereal in 2008, it had a debt to total assets ratio of 81%. In 2009 it's 78%. What does that tell us? It tells us that we are actually paying our liabilities down a little bit. The amount of everything we own that we owe to other people has gone down quite a bit. But if we take a look at the industry, we see that on average people are below the 50% mark when it comes to the amount they owe compared to what they own. And so the industry average is about 48%. General Mills is at 71%. So we owe a lot of money to people. So we owe more out there than others do. The times interest earned ratio, also called interest coverage ratio, that tells us, do we have the ability to make our interest payments on our loans, our debts, when they're out there, as they come due. And so if we take a look at it, the times interest earned, we're going to take our net income plus what we pay out in interest plus our taxes, and we're going to divide it by our interest. It tells us the ability to meet those interest payments as they come due, as we actually have to pay them. And so if we take a look, Chicago has a times interest earned ratio of 5.8% both years. And we also see we're right about there with the industry average. Now General Mills, however, they're a little bit better. They can pay theirs a little bit better than we can. Alright, then we have the cash debt coverage ratio. This gives us our ability to repay our liabilities from the cash that we get from operating activities only, without having to sell off stuff that we use in our operation. So our cash from operating divided by our average total liabilities. And we have, for this company, a cash debt coverage ratio of 17%, 0.17. General Mills only has a 14%. And so we're able to pay, using our operating money, our cash flow from operations, to pay toward our liabilities a lot better than others, which kind of helps to explain how we went down when it came to our assets compared to our liabilities. And then we have something called free cash flow. Free cash flow is going to be a dollar amount. And what that's going to be, it's going to be our cash from operations minus our capital expenditures, anything big that we buy, minus our cash dividends. And so it's going to tell us how much cash we have left over to pay other dividends or expand operations or whatever else we're going to do. And so this is how much cash we have to work with. And if we see, we as a small company have a pretty good amount of cash, free cash flow, left over after paying those capital expenditures and dividends. So right about on par with General Mills. Alright, we looked at liquidity ratios, we looked at solvency ratios. Now we're going to take a look at something called profitability ratios, and what those tell us is how well we're doing. Are we making money? So we're going to measure the income or operating success of our company over a period of time. Are we actually making money, turning a profit? And the first ratio we're going to look at is the return on common stockholders' equity. Return on stockholders' equity shows us how many dollars of net income we have compared to what was invested by the common stockholders. Not preferred, but common stockholders. So we take our net income minus our preferred stock dividends, because we got to pay those, divided by our average common stockholders' equity, what the common stockholders have in this business. And so it tells us how profitable we are compared to our common stockholders' investment, what the stake of those common shareholders is in the company. If we take a look, 2008 and 2009, we were at 46 and 48%. So we were doing pretty well. It's a little bit high, actually, compared to General Mills and the industry hovering around the 29-30%. And so relative to what the shareholders, the common shareholders, have in this business, we actually make a pretty good net income. And then we have our return on assets ratio. And what we're looking at there is what our profitability is compared to the assets that we invested in this company. So our net income divided by our average total assets tells us how well we're doing. For what we put into this company, what we bought as assets, how much return do we get, how much net income do we get. And we see in 08 and 09 we had 9.4%, and then 09 10%, so we're going up, and either way we're above the industry average, and General Mills, the big one on the block, we're above both of those. So we make a pretty good return for the assets that we put into the business. Then we have our profit margin ratio. Profit margin ratio, also called return on sales, so also known as return on sales. And what that tells us is that for every dollar in net sales, how much do we make as net income? Now, we actually saw this earlier when we took a look at that vertical analysis, and we saw that our net income was 9.4% of our net sales. And so net income divided by net sales, that's the net income generated by each dollar of sales. We keep 9.4% of every dollar that we make in sales, we keep that as net income. But we're a little below the industry average in General Mills, and so a little bit less than what they make. They make a little bit higher, 10.6%, 10.4% for the industry average. So we're almost there, but not quite. Then we have the asset turnover ratio. Asset turnover ratio is going to be our net sales divided by our average total assets. So that tells us how efficiently we use our assets in order to make sales, not net income, but sales. And so we see in 2008 and then 2009 we had a 1.02 and a 1.07. Now this is a lot like the profit margin ratio, but it doesn't take into account the bills that are paid out. Alright, one interesting thing, if we take a look at it, the profit margin ratio times the asset turnover ratio becomes the return on assets ratio. So they all kind of go together. Net income divided by net sales times net sales divided by average assets is net income divided by average total assets. So if we crossed out net sales with those, we would end up with three different ratios that kind of go together. Alright, then we have our gross profit rate. This tells us how much money we keep in our pocket as gross profit after we pay our cost of goods sold. So it's our gross profit divided by our net sales. The gross profit that we keep after cost of goods sold divided by net sales. And we have a gross profit rate of 44% both in 08 and 09. The industry is lower, as is General Mills, which means we don't pay as much for our cost of goods sold as the industry does and General Mills does. It means we're being a little more competitive that way. We're being a little more efficient. Alright, now we have our earnings per share, and what that is our net income minus our preferred stock dividends, because we have to pay those anyway, divided by the average number of common shares we have outstanding. That tells us for every share of common stock out there, how much of that net income we made goes to each one. And so we take that net income, divide it by the number of shares we have out there. And so our earnings per share for 2008 was $2.40, but in 2009 our earnings per share went up to $2.63. General Mills, on the other hand, their earnings per share is a heck of a lot higher. So they have $3.93 in earnings per share. They make a lot more money than we do overall. Alright, then we have the price to earnings ratio, the PE ratio. That tells us what the shareholders think out there. It's our stock price per share divided by that number, earnings per share, that we just calculated. So stock price per share divided by the earnings per share. It's the relationship between the market, stock market, and how much we made. So it's how much our stock is trading for compared to what we actually made. A higher price to earnings ratio tells us that people are wanting that stock. So they think that our business is going to do pretty well, and so the price is up there compared to what our earnings per share was. So if we take a look at us, 20.9 and 20.1 in 08 and 09 respectively, it went down a little bit, but it's way above the industry average and General Mills as well, and so people want us a little bit more. Alright, then we have the dividend payout ratio. It tells us the percentage of earnings that we're going to pay out as dividends. So how much do we pay out in dividends to common shareholders, not preferred, because remember, preferred, you got to pay those anyway. It's going to be our cash dividends that we declare on common stock only, though, not preferred, divided by our net income. So it's the percent of our net income that we pay out in the form of dividends. If you see, we're kind of right on par with General Mills, but the industry, they don't pay out dividends quite as well as we do. So General Mills pays out dividends pretty well, and we pay out probably about the same as them, but the industry as a whole, they only pay out 37% as dividends. Alright, and these are the ratios that we want you to be responsible for. These are the ratios that I want you to take a look at. And here's sort of an overall list of what they are and how to compute them.